Thanks so much for tuning into BQ Conversations. I'm your host, Neeraj Shah, with Tamanna Inandar. And the big news of the day is India's inclusion or forthcoming inclusion in the global bond market, emerging market index. To make sense of this, the implications, short-term, medium-term, long-term, two very important guests, Sivakumar of Axis and Jayesh Mehta of BofA, join in. Gentlemen, thank you so much for taking the time out. Siva, let me start off with you. Your first thoughts, I mean, this was a long time coming, finally happening, initial reaction.
Yeah, I think it's something we've been waiting for a long time. It's many years, and every year this gets pushed back. And in fact, there was a point of time after the budget this year when there was no announcement regarding this, that people thought that this has been put on the back burner. So certainly it's welcome news in terms of being included in the global bond indices. Of course, many steps have been taken over the years, and this is a culmination of all of that. So the initial market reaction obviously is very strongly positive. You've seen yields drop by 7-8 basis points at open, and markets are reasonably well bid. And if you look at the bond markets over the last few days, despite the global sell-off, our bonds have held value largely because of some anticipation that before the end of this month, probably we get this. So I think the anticipations have borne out this time. Was belied last year. I'm happy to know that this is borne out this time. I think this is really welcome news for our markets in terms of longer-term growth, development, liquidity, etc.
All right, let me get in Jayesh Mehta as well. Jayesh, great to have you on the show and great to speak with you on a very, very important day. Some estimates say about $30 billion of inflows coming in. Do you have a number in mind? And will this also have a domino effect of the inclusion of Indian bonds in more indices?
Of course, it will be included more into the next. We expect it to be in Bloomberg Index, but JPMorgan EM Index is the one which is mainly followed and tracked. And yeah, that's a rough estimate. People have 30 because they're kind of going by 2x number. It could be more because when you have something included in index, not only the index followers, even other central banks and all kind of tend to get more comfortable, and therefore I would expect the flows to be much larger than that. But that's of course over a period of time, maybe 24 to 27, 26, 27. That's when you will see larger flows than this. Maybe the 30 billion is what we should see in 24, 25, but beyond that, we will be seeing higher numbers. And of course, it's also a factor of emerging market bond AUM growth also. So that also one needs to factor in.
Do you have a ballpark figure in mind when you say a higher number by 26, 27?
So it's right now, we are assuming with like 30 billion is the number which is floating around, which is kind of assuming maybe like 1.8 times the emerging market bond investors. We have typically seen to maybe 2.5 to 3, so maybe another 50% or maybe another 25% higher could be possible in next. So basically, it can go up to 40 billion kind of situation in the next 4 or 5 years.
Just before we let you go, though, in a world fraught with higher yields, what does this mean for the intermediate period until the inclusion happens and now?
That's why you see the reaction today. There is of course some profit booking happening. It opened at 707, went up to 711. So if U.S. macro would have been conducive, U.S. yields would have been lower, we would have seen the opening today at 690, right? But that's because right now, as you said, like global yields are higher, and therefore, otherwise what happens is the real guys, the people who are tracking the index, 1%, they will start doing from June, right? But other hedge funds or other traders and stuff like that, they're not going to wait for 1st June. But it's right now, it could not be that easier to just go there with U.S. yields being almost around 4.5%. That's where it is kind of giving us, which is good actually. It's giving a slow ride.
Yeah. Yes. So, Jayesh, appreciate you taking the time out, being with us. Thanks for your time.
Thanks.
All right. Siva, now these 2 or 3 questions to you and more. First, the point that Tamanna asked Jayesh as well. One is let's assume the longer term impact of this particular event is well documented, though I would love to understand from you on that. And two, the domino effect of what this does in terms of other indices and also in terms of idiosyncratic buying that other global funds would do, which they might not be doing right now because it was not there in the benchmark any which ways.
Yeah, I think these are all very important considerations, right, from our perspective. I think the point that Jayesh is making and the point that you made just now, which is that what is in some sense, non-index linked buying, I think becomes extremely important. What is well documented in some sense is the size of the funds which track or which are benchmarked to the EMBI, and therefore this estimate of little over 20 billion of flows. And so then how do we build up an estimate from there is to look at what are potentially the kind of monies which are not directly benchmarked to the EMBI, but which tend to track EMBI, and that would include, as Jayesh also mentioned, certain sovereign wealth funds or other investors who would follow. And then, of course, the domino effect, which you mentioned, that this opens a tap hopefully for other indices, other benchmarks, also for inclusion, for Indian bond inclusion. Now, remember that India is not the first global index or a regional index we've been part of. For example, we are part of certain HSBC emerging market indices and certain other EM indices, EM local indices already, but they tend to be much smaller in size. What's really important is to get into some of these big global benchmarks because they have a material impact in terms of flows, right? So I think obviously the big daddy is like, for example, the Bloomberg global aggregator, etc. And if that happens over a period of time, and obviously it's going to be a game changer in terms of the total size of flows. So we'll have to see. I don't see this as an automatic domino, but certainly this will start a conversation in many asset management companies and index providers that India is important place. What's also important is that this has happened at our own terms. So in the sense that, the sort of what was considered to be blocking events such as tax and the withholding tax on bonds and the clearing and settlement, etc., seems to have not played much of a consideration. That is to say that the index providers and the investors seem to be comfortable in trading bonds even without it being settled on overseas exchanges and trading platforms. So all of these are important. I think it's important that we recognize that this step is just the first step. Hopefully, there will be a lot more. As RBI also develops comfort with global investors investing in India, hopefully the RBI also will be more comfortable in allowing Indian bonds to be settled on global exchanges, which will then make it, that's the real domino effect, right? Or rather the kind of TikTok effect where there's one move here and there's the corresponding move on the other side. So if the government and the RBI take the next step, certainly I think we'll see way more positivity towards the Indian bond.
Yeah. Siva, actually, just two very, very crucial points. One, that you mentioned, that one, it's happened on our own terms, part one. And two, the layer that I'm adding is that the most spoken about bond market inclusion was the JPM one. Now, yes, it may not be an automatic domino, but does it, in a sense, open up and make other indices hasten the process if they hitherto were not, because JPM was the most talked about? And could that also happen at our own terms?
Yeah, I mean, I don't know. Of course, there's no way to prove this one way or the other right now. But let me say this way, that what this tells you is that there is a larger acceptance of Indian bonds, in this case Indian gilts, in the global investor community. So the index provider is, in a sense, reacting to the demand from their customers who are asset management companies globally. So, in a sense, Indian GSECs are finding acceptance in global asset management. And the same feedback will be going to other index providers too. So, I think the point is that as investors, that is to say AMCs globally, get used to investing in Indian GSECs, that will translate, in my opinion, to other index providers also following suit. Now, whether that happens on our terms, etc., that remains to be seen. But I think in some sense, the success of this first step and in implementation can give a lot of comfort to other index providers that Indian GSECs can be traded in India successfully with access to liquidity, with access to settlement, etc. and that might provide the kind of comfort that index providers would need.
Siva, let me come in with a sort of a, I would say, broader and simpler point of view of why this is such a big deal. I mean, geopolitically, it's coming at a time when Russia, of course, has fallen out of favor. China is looking a bit iffy. India has a growing acceptance globally of inherent strength in the economy. And is that why also, of course, beyond the excitement of the markets today, this is really a big deal? Can you give us some perspective on that?
Yeah, I see the point here is very important that it's been a long, 20 plus year journey that we've been talking about this whole capital convertibility and inviting global investors to invest in India, etc. And it's been only an equity story so far. Right? Fixed income investors in India have been essentially traders, those who want to take the, to use Neeraj's word earlier, idiosyncratic investors, those who want to take a punt on India or a currency. So we have not really had stable long-term flows into Indian G-Secs or into Indian bonds in general because we've never really participated in that kind of index type of flows. So I think this, therefore, is an extremely important step to integrating our markets with the rest of the world. As we become a part of a larger pool of money globally. It also will lead to more institutional tracking of Indian macros, Indian rates, and commentary, etc., which is hitherto been lacking because, well, no one was invested here. Right? But I think in all of these respects, we should welcome this. This is the macro, longer term, I think, development that we should be really welcoming as a result of this step. Now, coming to the other point, the tactical aspects in some sense, as you mentioned, for example, Russia being knocked out of some of these indices. But even without Russia aspect, I mean, if you look at India will become a 10% weight in this index. Why? Because there's a 10% ceiling on a single country. So we are already a large bond market and we are the largest market not covered in this index. So in that sense, there's always an outstanding pressure from a global diversified investor community that why is it that one of the largest emerging market bond issuing countries is completely unrepresented. So from the investor perspective, this need to be in India is definitely seen. We are relatively better off, of course, remember the taper tantrum for 10 years ago, but that's a decade ago. And I think the reality is that the currency has done reasonably okay, in fact, remarkably stable over the last several months. And all of that would also contribute to the confidence that global investors have in investing in India, apart from the normal things that people look at, like stability, macro stability, financial stability, etc., which have also, I think, improved significantly over the years.
Siva, last one or two questions very quickly. One, what happens to actually? Let me first ask about the flip side of this. We are fairly an event-driven country. The going is good right now. But this opens the tap both ways. Anything that, and there have always been a conversation about how the Indian bond market lacks the depth. Now, my question to you is there something that we need to within as well to ensure that things don't go awry when the reverse side is ongoing?
So the good news here is that when you're part of an index, you don't get trader flows, right? You get investor flows. So let's say you're 10% of an index and roughly you will be 10%. The ETFs will give you exactly 10%. The non-ETFs will be plus or minus depending on the active view of the fund manager, but in and around 10%, right? So in that sense, that's allocation money. That's not trader money. So you don't have to worry about that flighty nature, which today is the case, right? Wherein only money which comes to you is because someone has taken a punt on it, right? And therefore that money can fly out at short notice. So that's a good news, right? So let's celebrate that. But we must be aware that this will increase the scrutiny of India in the global scheme of things. We will be compared to other countries. There will be commentary which talks about, for example, Indian fiscal health relative to Indonesia or China or Malaysia or someone else. And so we need to be prepared that we will be held to greater account in the global commentary, even if not in terms of flow. And I think it is something we need to be aware of. I don't think the risks in this case are too high. I think the risks are very low. I think we tend to worry about this flip side, but I think in this at least particular instance, I'm not seeing too much of concern that we should be having about the negative implication of this inclusion.
Great. Siva, thanks so much for putting all of this into perspective. Much appreciate you taking the time out and being with us on the show.
Thank you, Neeraj. Thank you, Ramana.
And viewers, thanks for tuning in.